Hello and welcome to Compound Thinking. Is Adobe a generational value opportunity or is it an epic value trap? I've only got about 20 minutes before I have to get back to the rat race, so let's get into it. My name is Brennan Ruby, and what I'm trying to do is become a better value investor and bring value investing principles into the modern investing landscape. Without further ado, I want to get into it, but a quick disclaimer first. I am not a financial advisor. This channel is me sharing the research I do as I try to get better at value investing so that everything here is what I found and how I'm thinking about it, not what you should do with your money, and no guarantee that my buy-sell ratings account to any wealth generation for anyone who takes that advice. All right, so today is Adobe, ticker ADBE. On the numbers, it looks like one of the cheapest big software setups in years, but there's also a real chance that AI changes the business in a way it doesn't recover from. I came out at a composite score of 7.85 out of 10, and the math to me points to a strong buy. And I want to walk you through both sides and let you decide for yourself, and I'd love your feedback as well in my thought path and thinking. There's three things in the next 10 minutes that I want to cover. One, why the financials look like a generational bargain. Two, why I'm not certain the AI threat isn't a footnote. It's a real possibility that the whole business gets restructured. And then three, how I'm personally sizing it. I'll give you my price ladder and I'll show you where I'm getting in, where I'd probably trim. But again, this is my price ladder. It matches my goals, my analysis, my risk tolerance. This is not meant to be any sort of recommendation or personalized advice for anyone watching the video. I just want to give you guys an idea of how I'm looking at the current situation for Adobe. Adobe is basically the infrastructure of professional creative work and digital documents. Digital media is the engine for Adobe. It's 74% of revenue, which is about $17.6 billion, and that is up 11% year over year. That's Creative Cloud, so Photoshop, Illustrator, Premiere, plus Acrobat. And then the digital experience space of the business, which is the enterprise marketing platform, is about a quarter of the business. The thing to get is PDF is theirs, PSD is theirs. The file formats that companies use to ship anything visual or contractual trace back to Adobe. That's a standard, and standards have real moats. But here's the question that runs through this entire video. What happens to a creative software standard when the creative work itself can be done by a prompt? Hold that thought just for a minute. I want to go into the financials because the financials are what actually hooked me in this investment in the first place. Revenue is at $23.8 billion, operating margins at 38%. So the software peer for them is around 22% operating margin. So Adobe runs at almost double their peers in terms of operating margin. The return on invested capital, which is basically how much they earn on every dollar they put to work, is 37% against a cost of capital of around 8%. That's a 29-point spread, which is a textbook wide moat economic setup. The free cash flow is almost $10 billion, a 41% margin, and at today's price of around 244%, the free cash flow yield is around 10%. The market is handing us roughly 10% in cash every year while the business grows revenue at 11%. Even after you back out stock-based compensation, we're still looking at about an 8% free cash flow yield based on today's prices. So the numbers say it's cheap and it's a high-quality business. If you stop there, you'd wonder who is selling at the current prices. The next two slides may help answer that question. Now let's talk about the moat. I gave them a moat score of 7.3 out of 10. Honestly, though, the moat is bifurcated. It's split in half, and I'm really confident on half of it. The half that I am confident in is the enterprise. Adobe has trained its Firefly AI commercially licensed images, and it gives enterprise customers legal indemnification. So if you're the legal team at JP Morgan or Disney, you literally can't use Midjourney. The IP risk right now in today's climate is just too real. It's too high. This makes Adobe, to my knowledge, the only commercially safe AI image tool at enterprise scale. That is $250 million in Firefly revenue, which is growing at 75% quarter over quarter. That is a real defensible moat when it comes to enterprise. The half I'm not confident about is the consumer. Photoshop, Illustrator, Premiere, those are products where the underlying task, make me an image, make me a video, is increasingly being done by a prompt instead of a tool. Canva is real. Figma won product design. The next AI models keep getting better. Does professional workflow lock-in survive when the work itself shifts? I genuinely don't know. Like, the analysis assumes it does, but that's my assumption, and it's not a fact. Today's 37% return on capital doesn't tell you what it'll be in 5 years. Now, before we get into my full valuation analysis and bull and base case scenarios, I want to focus on the bear case scenario because that is what the market's pricing in. I think that's the most important thing you have to be aware of before you invest in Adobe. My risk score for this analysis was 5.2 out of 10, which is a medium risk. But the number I actually want you to hear is the 8 to 12% chance of permanent capital loss. That's not a zero chance. That's a real chance this doesn't work out even at today's very cheap prices. The big reason for this is AI. The reason people pay for Photoshop is that making a quality image is hard. AI is making it not as hard. If a marketing team can prompt a finished campaign asset out of next Sora or Mid-Journey models, the big tech solves the licensing problem, then Adobe's flagship products lose not their moat, but their entire purpose for existing. No amount of workflow stickiness saves a tool whose job has been automated. Right now, the data leans the other way. Firefly's growing, churn is not spiking, but 3 years out, I can picture Adobe still printing $10 billion in cash. I can also picture the consumer franchise being half of what it is today. Both are live possibilities. 2 more risks that we need to consider. The CEO succession. Shantanu Narayan announced he's leaving back in March, which it's now mid-May and we still don't have a name that's going to replace him. Whoever takes over has to navigate the AI gauntlet, and the wrong person at this exact moment could spell failure and could be the reason why we hit the 8 to 12% permanent capital loss. You've also got the Figma gap, which is the third risk that I want to factor in. Adobe tried to buy Figma for $20 billion but got blocked. They paid $1 billion to break free and still has no real answer to project design. That's a huge gap in their offering, and Figma owns that space at this current moment. So it's not this isn't a risk-free, it's not a no-risk, free money situation that we have with Adobe. It's a high-risk, high-reward situation, and the data currently leans in the favorable side of outcomes for Adobe. All right, now we can talk about valuation. The valuation, for the valuation methods, I ran discounted cash flow, owner earnings, reverse discounted cash flow, and then sum of its parts, and they cluster all to around $529 per share. With the current price at about $244, we'll call that a 54% discount or margin of safety. Again, this is my fair value and intrinsic value for Adobe. That doesn't say that your analysis or any other reasonable investor's analysis would come to the same results. But here's the cleanest way to see it. Run the math backwards. If we run the math backwards, what growth rate is the market pricing in today? And for that, it's about 6% perpetual growth. It's currently growing at 11% and has a 30% return on invested capital. And here's the kicker. Even my bear case model, with AI fears playing out and multiples staying compressed, lands at around $380. The stock's trading well below that. So the market isn't pricing in my bear case. What it's doing is pricing in something much worse. And that, to me, gives us an asymmetric opportunity for a risk reward. Again, we could lose everything on this investment, but when you look at the upside and you look at the downside, I believe that there is value here for me to invest in it with a certain percentage of my portfolio, but we'll get into that in a minute. First, I want to look at historically, has Adobe traded at, above, or below its intrinsic value? Because there's one more thing that I would check for. What I want to make sure is Adobe is not a cheap stock that is always cheap relative to its intrinsic value. So I went back 12 years, which is basically Adobe's whole subscription era, and asked, has the market ever actually agreed with my fair value of this company? And the answer is yes. For about half of the years, it traded at or above the intrinsic value at that time. So I ran my model, my analysis, based on data in the past, and about half of the time, the stock market was giving Adobe its fair value in terms of price to intrinsic value. But today, Adobe sits at the 0th percentile. It's never been cheaper when it comes to its intrinsic value. And even after an 8% bounce off the April lows, it barely moves the needle. The closest analog I have for Adobe is 2016. Cash flow was surging, stock was disconnected from the actual financial results, And from there, it returned 77% in a year, and it returned 148% in 2 years. There's no promises that's going to happen again. And 2016 didn't have a existential AI question. But the point holds, this isn't a stock that's been cheap forever and stayed cheap forever. All right, so here's a full look at the scenario analysis that I completed. I weighted them about 25% bull, 50% base, and 25% bear. The bull case comes out to $810 over 3 years, which is roughly a 230% total return. AI reaccelerates the creative business. Enterprise Firefly scales past $1 billion in revenue. The CEO handoff goes clean, and multiples expand. For the base case, it's about $590. This is about 140% return over 3 years. The modest funnel conversion of free to paying customers, an internal CEO, growth holds, multiples re-rate part of the way to where they normally are. And then for the bear case in the scenario analysis, I actually arbitrarily lowered from my initial bear case, which was 340. I just wanted to bake in even more conservative risk approach to this because the stock price is disconnected from the financials. And so like my bear case gives too much credence to what the company has done in the past and where it is today versus what the market is expecting. And so if you even look at a bear case of 297 and not 340, you're still about a 20% margin of safety from where the stock price is today. So weighted, that's around $543. And even if I haircut it the 8 to 12% chance that we lose all of our money, it's still comfortably above the $244 mark, which is the whole tension. The expected value math says favorable. The tail risk of being wrong about AI says don't bet the farm. All right, so finally, where did I land with all of this? So here's where my analysis landed and my framework, not advice for you. The deep value for me is under $353. And here's the thing. At $244, we're already below that for about 30%. I find it attractive as a buy around $423. I would probably start trimming at around $615, and then I would probably fully exit the position if it ever approached $700. Personally, at $244, I do own it. I am up a little bit on the stock. I never thought Adobe would be something I owned as a value investor because software companies and high growth companies tend to trade at multiples that just are not attractive to a value investor. But the SaaS apocalypse has created some opportunities in stocks that I may not otherwise own. So for the full transparency, I do own it. My average price, it was in the high 230s. I am probably going to add more as things play out. But again, this isn't a huge position for me because there is a risk of losing all of your money. There's some investments where you can pretty much all but guarantee you're not going to lose all your money. Adobe is not one of them. It is possible Adobe becomes a Kodak or a Blockbuster. I mean, it could get phased out to the point where the investment is near zero in value. But if you look at the risk reward and the current value of the company, it's definitely lower than it should be. And that is why I initiated a position. If there's one thing that you can take from this, there are two ways to be wrong here. You can buy and watch AI break the business, or you can also not buy and watch the discount close. I don't know which one of those is the right move, but my position size reflects that. Whatever you decide, make sure it reflects your risk tolerance and your portfolio needs. Here's some things I'm watching for on Adobe as time goes on. If Firefly growth slows materially and the enterprise moat is cracking, that's a problem. If we get a next-gen AI model that has proper IP licensing, the commercial safety edge shrinks, and it shrinks really fast. If Creative Cloud net new revenue turns negative, that's the consumer thesis breaking. But on the other side, if we get a strong CEO, Firefly is holding its pace, Creative Cloud reaccelerates, those are all big data points that would lead to the upside for Adobe. The next big data points we're going to have are in June for their quarterly release, and I'm hoping that's also when we get a name for the new CEO. Well, that's where I'm at on Adobe. I hope this was useful to you. Please like and subscribe. If there are any stocks you want me to look at, please leave them in the comments section and I can run them through my process. And look, each one of my full analysis are a small novel. I can't imagine that there's much of demand for that, but if there is, I mean, it's got tables, it's got charts and all that. If there is demand for that, let me know and I'll think about ways to get some of that into your guys' hands. And there's a link in my description as well to Substack. That's most likely where I will be posting more of the full form stuff. If you want to subscribe over there, everything's currently free on Substack. If there's real demand for my full analysis, I'll think about ways to get that into your guys' hands in a reasonable way. All right, thank you for your time, and I'll see you in the next one.